Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, I want to talk about open data. More specifically, I was reading some information on the CFPB 1033 ruling. I'd gotten in a conversation with a security officer at one of our conferences that we were attending, and he mentioned this ruling. So the 1033 ruling basically states that subject to the rules prescribed by the CFPB, a covered entity, for example, a bank, must make available to consumers upon request transaction data and other information concerning a consumer financial product or service that the consumer obtained from the covered entity. So effectively, this seems to be saying if you're a bank or a credit union and the consumer requests it, you have to provide all transactional data to them. So as I thought about that a little bit, what occurred to me is, this whole conversation we've had around open banking in the United States, specifically, the core providers and whether or not the banks and credit unions actually have access to their own data. I thought I would try to reach out to somebody who has a little bit of experience in Europe. And Peter Tapling is going to join me today. And the conversation, I think, is around, this has got to be different in Europe. Open banking and the concept of, just being able to pass the material from a core to the bank or credit union and then all the way through to the consumer has to be much easier in Europe. At least that's my theory that I'm going with. So without further ado, I thought I would talk to Peter, see if he's got any insights into just, why is it different over there? Or is it different? How do they think about things on that side of the ocean as compared to what we're doing here in the United States? So without further ado, let's get to Bank Talk. Okay, welcome back to Bank Talk. Today I have with me Peter Tapling, Managing Director of PTAP Advisory. Peter, thank you for joining me today.
Happy to be here, Charlie. Thank you for inviting me.
So, Peter, when we prepped for this, you just had an interesting background. We kind of decided that we would spend a little bit of time talking about the difference between open banking in general in Europe versus the United States. And I thought it might be helpful to the audience to just, if you could just give us a couple of minutes on where you came from.
Sure. My background, long ago and far away, I was a technology guy, actually wrote code for a long time, spent an enormous amount of time in the areas of information security and identity. And 20 or so years ago, started working with financial institutions and payment service providers and e-commerce companies around trying to protect their payments, the way that they move money from fraud. And there's an overlap between fraud management and identity management, and that's kind of where I've lived. So, not going into the deep history, but I founded a company called Authentify. Authentify is the group that invented out-of-band authentication as you know it. So you can blame me whenever you get one of those annoying 6-digit pins to support a login. During that time, my first customer at volume was PayPal. So, of course, deep in the payment services space. During the launch of faster payments in the UK, 3 of the largest financial institutions use Authentify to protect instant payments in the UK. That was circa 2007-8. I participated in the Faster Payments Task Force. I was a steering committee member of the Secure Payments Task Force. Those are both organizations promulgated by the Federal Reserve. Authentify eventually sold to Early Warning, and I was the chief revenue officer of Early Warning during the launch of Zelle. So I come at this not from a banking perspective, but I really understand financial institutions and payment service providers and the payment networks and how they work. And I understand how the technology works.
Excellent. Well, thank you for the background. So I prepped this a little bit, Peter, not with you, but with the audience by saying I came across this Section 1033 CFPB ruling. Seems to say that financial institutions are now responsible to the consumer for making sure that the consumer can get every transaction from them. Where my head went was this conversation around how does a bank even get that information from their providers, their vendors? And then, as you and I had talked in the prep, I thought to myself, I think it's done differently in Europe. Like, to me, I just wanted to spend maybe a little bit of time around how does this, open banking or this concept of, passing data, how did it spawn in the United States? Or, was there a difference in just the way it was formed? And I'd like to just kind of ask you, could you give us just a little bit of background on, is it different in Europe or is it the same? What's your perspective on that?
Indeed, it is very different in Europe and the UK. So the phrase open banking actually had its root over in Europe on the other side of the pond from the United States. One of the things you have to remember is those are very different banking environments. In the UK, there are 5, 7 large financial institutions, maybe 200 in total. In the EU, you have the European Central Bank and the European Central Banking Authorities, which can propose rules across the entire scope of the European community. The other thing is it's a very different political environment. So in the US, we tend to be very market focused, let the market take over. Whereas in Europe and the EU, they're much more comfortable with regulation. And the regulators themselves and the politicians are very consumer focused. So open banking, the phrase open banking, ties its roots back 15 years with the idea that the data that's held by a financial institution on a consumer is not the financial institution's data, it's the consumer's data. And that if the consumer wanted that data to be used or that information to be used to consume another service, the financial institution should make it available to the consumer. Now, in practice, what that means is if I wanted to open a Revolut bank account and I wanted Revolut to get the account number from my Lloyd's bank account, Revolut should be able to talk directly to Lloyd's under my instruction and through my authentication and pull that data. So because there was more structure around it, there were organizations created and there were APIs that were created, standardized APIs that all financial institutions needed to support under regulation. So that's where it got its start. Again, 10, 15 years ago, EU, UK. And that's where the phrase open banking came from. Here in the US, we have a bunch of data aggregators who have essentially purloined the phrase open banking. It's not really open banking. So you could go to api.wellsfargo.com, api.chase.com, api.capitalone.com, api.insertyourfavoritebankname.com, and you will find a whole host of APIs, but they're all very specific to that particular financial institution. There's no standard. And so when JP Morgan Chase just came out with an announcement that said, hey, we're doing pay by bank via open banking with MasterCard. Well, how does that really work? Well, JP Morgan Chase is consuming a product at MasterCard called Finicity, and Finicity is a data aggregator. And so the data aggregators have purloined this open banking phrase. I'm not saying it's invalid. What I'm saying is it's very different from what is going on in the UK.
Okay. So let me unpack that just a little bit with a couple more specific questions. Take that to the community bank space. Let's drop it down a notch, right? Because I think there's been some argument that a community bank specifically is maybe being held by a couple of large providers as well. And generally speaking, those providers, not the bank as an API. If they wanted another vendor to touch, let's say the core vendor, they would have to go through the core vendor's API as compared to something maybe written at the community bank. Does that resonate, or can you give us any thoughts on that?
Yeah, I'm going to go back a little bit because you brought up Dodd-Frank 1033. So remember, Dodd-Frank was a bill that was passed after the financial crisis, 2008, 9, 10. It was revisited. There was some work done on specifically Section 133, which is only 2 or 3 sentences, starting in 2016, 17. President Biden through executive order, told the regulators to, air quotes, do something around allowing consumers to have access to their own data through a financial institution. CFPB has picked this up and is now, they have a notice for proposed rulemaking, I think, outstanding on what they're going to do on 1033. And you are correct. The financial institutions are kind of all over the map in their response to this. I have heard from some financial institutions that if it was a standardized API, that might be good because they could use it and they would get as much benefit as if they could offer it. If you go down market, now again, remember the United States, very different financial structure to the financial industry. We have something on the order of 9,500 or so regulated financial institutions between banks and credit unions. And so you get past the first 200 and the chances that they run their own infrastructure is near zero, right? Mm-hmm. And so under Dodd-Frank 1033, the idea was to begin to make open banking in the US look a little bit more like it looks in the EU and the UK, which is there would be a standardized API. That standardized API would be published by the financial institution, air quotes, by the financial institution, so that other parties using that API and under the authentication and authorization from the consumer could reach in and get that data. So now let's go to your question, which is some financial institutions are saying, wait a minute, I don't actually have the data. It sits somewhere else, right? So yes, most financial institutions, you get under that top 200, so 9,300 plus financial institutions use a core service provider to provide their back office processing. What that means is, if we take the sentence I used earlier, that the financial institution will publish an API, it means that the core provider for that financial institution must publish on behalf of the financial institution some API that can reach in and get the data that would be required. And so the bank has it, and the bank's service providers have it. And the pushback from the financial institutions is, wait a minute, this is just another thing that my core provider is going to charge me for. Indeed, the core providers today have API platforms available to the financial institutions so that they can offer APIs to external parties. Maybe a business wants to be able to do some automated capabilities with the financial institution. But by and large, those API gateways are something that the core service providers charge in addition to the other capabilities that they're offering for the financial institution. So it becomes, today, it's kind of a dollars and cents thing. Am I going to get enough value out of offering these APIs to make it worth paying the service provider? In the future, where 1033 requires that this stuff becomes available, it now becomes a regulated cost as opposed to a choice.
We'll be right back.
If you're dealing with a technology vendor, consider giving Remedy Consulting a call. At Remedy, we're dedicated to helping our clients get the most out of their tech spend. If you're considering changing one of your major tech providers or are renewing a contract with a vendor, the Remedy team may be able to add some value. Our clients enjoy our deep experience working inside these major vendors, and that background helps us ask questions which eliminate headaches and expense for our clients. Sometimes that's immediate relief, in the way of your vendor invoices, and sometimes that comes in the form of contract language protection for a strategic move that you may want to make several years later. The group of experts at Remedy have years of experience in core systems, digital, mobile, payments, item capture, commercial banking, pretty much the whole gamut of technology for financial institutions. Remedy approaches the BankTalk podcast the same way we approach our client engagements. We always try to fill some knowledge gaps, but also just to have enough life experience stories to remain entertaining. So if you're renewing a technology contract or you have projects going on, just need another opinion or a project manager from outside your organization, reach out to us at remedyconsult.net. Thank you, and we appreciate you downloading the BankTalk podcast. Now let's get back to our episode. Yeah, and that's very interesting. I think the other thing you said there that maybe we should spend a couple minutes on is, I think you said, the European regulators, for the most part, and now again, let's call them 10 to 15 years ahead of us, right? They published a standard. I'm fairly certain that across, if you look at the top 5 banks and then go downstream and look at, there's going to be a little batch at the top that maybe potentially have their one set of APIs, and then as you get down below, you really have to define that API probably by the provider. So it's more than one standard by a long stretch. It could be 10, 15, 20 standards. Is that fair, or is it?
Well, today it is. Yes, today that is true, right? One of the efforts that the CFPB is undertaking under 1033 is to create authorized APIs. And so, there's an organization, FDX, the Financial Data Exchange. They've been operating for quite a while. Rohit Chopra, director of the CFPB, spoke at the recent FDX conference. They had their annual conference and basically said, we, the CFPB, are looking to industry consortiums that are not driven by one party, that do not appear to have entrenched economic interests and are working in the benefit of the industry. I'm putting words in his mouth, but it's roughly something like that.
Yeah.
To create these standardized APIs. And so if we move the calendar out 5, 7, 10 years, if the vision of 1033 is met, the vision of what CFPB is trying to do is met, there would be 1 to N providers, 1, 2, 3, 4 providers, which are probably going to be some form of industry consortium. And they will have a set of APIs, and financial institutions will get to choose which of those APIs would they like to use. Unclear at this point whether across those consortia, if there indeed ends up being many, the APIs have to be the same, or if they just need to meet the same objective. Now, if they need to be the same, then yay, because we'll have kind of exactly what they have overseas, which is there's one API standard. Everybody writes to the API standard. And if you're a fintech, now the only thing, it's the same API, you've coded exactly the same way. It's just you go a different way to get to the endpoint for the bank, right? Assuming there's multiple consortia. If each consortia gets to choose their own API, well, now as a consumer of these APIs, I have to code differently depending on where I'm going. It would still be better because today, saying we have 9,000 financial institutions, let's say only 200 of them actually offer APIs. I still have to write to 200 different API specifications and potentially sign bilateral contracts with 200 different organizations, right? So, if we go out 10 years, it should be a lot easier. Between now and then, CFPB has notice of proposed rulemaking. Chopra is on the record saying, yes, we are looking at identifying consortia to specify these APIs. He said this at the FDX conference, so one might want to go look at the FDX APIs because I'm guessing they would be in the running to be one of those consortia. And then now what happens? Well, again, it's another part of our conversation, but once CFPB is going to come out with a rule, once it comes out with a rule, there'll be an implementation timeframe, and we're going to find out as time goes on how well integrated it actually becomes in the ecosystem.
So, Peter, I wanted to just understand a little bit better about how from rulemaking to actionable event occurs. It just seems to me like there's a big difference between what could come out of this than what the rule said at a very high level. How does a rule get made, and is this years away from being implemented? Is it no way to know? Is it a month? How do you go from rule sort of to actionable items?
Yeah, no, I think we're pretty close. I don't think it's going to be years, but the important thing here is to note that the years have already gone by. Remember Dodd-Frank, 2008, 2009, 1033 was part of that rule. The CFPB picked it up in 2016 and started doing community engagement, banking community engagement, et cetera, to ask questions. So generally what happens, and this is rules that result from a law. Congress passes a law. In the law, somewhere they say the relevant authorities, typically by some date, should propose rules and an implementation process to make this law effective, right? So very rarely does Congress say, this is how the bank must behave. Congress tells the regulators, create a regulation like this. The regulators then go off. They very rarely will say, go into a closet, write 15 pages of rules and publish them. They evaluate the situation. They understand how this overlaps with other rules. They have some period of stakeholder engagement. In the case of 1033, there's been stakeholder engagement going on since 2016. And then at some point, they get closer to writing a rule. So depending on the organization, sometimes there's a Federal Register notice for a request for comment. In the case of this rulemaking effort right now, the CFPB has issued something called there's a phrase for it, but it's their notice of proposed rulemaking, right? This is their comment period. They have basically come out and said, we intend to issue a rule on this topic that's going to roughly look like this outline. Please give us your comments. And so that's the period that we're in now. Typically, that period lasts for somewhere between 2 and 6 months. And then they go off and think about it some more. That's another 2 or 6 months. And then there will be a rule. Oh. So we're kind of at the back for relative to 1033 and this open banking API thing. We're at the back end of that multi-year process. So I would predict that we likely have something from the CFPB yet this year or early next. But like I said, it's a bit of spaghetti making.
And then once that's done, is there a period upon which, after the rule is made, there's a couple year period for people to implement? Typically,
I mean, you can't issue a rule in practice. It's just not practical to issue a rule like this that says 10,000 financial institutions have to do some relatively heavy technology upgrade, and they have to do it in 10 days. So yes, there will typically be a period of time, and that period of time varies depending on the complexity of the rule. From a technology implementation perspective, this is going to be relatively complex because the way it's going, there needs to be an API created by a consortium, and then financial institutions need to implement the API. We do have some APIs on the shelf. Like I said, I mentioned FDX, give them a little plug. FDX has some APIs that would be fit for purpose for this. I'm guessing it's not going to be 5 years, but I'd be shocked if there would be any kind of penalty process in anything less than 12 or 24 months.
And then again, that's just time to develop whatever comes out of the
rule. Correct. You give them direction. And by the way, once a rule is passed, then typically you have some kind of interpretation because people start raising their hand and asking questions saying, wait a minute, you passed this rule. What about this situation? Notice of proposed rulemaking. That was the phrase I was looking for. NPR. Anyway, so it is a multi-year process. Typically, we are at the back end of that multi-year process.
For this 1033 adjustment, are they?
Yeah, specific to CFPB 10. Yeah, CFPB's interpretation and rulemaking around Dodd-Frank 1030.
Okay. And then without getting too political, the other thing that jumps to mind is what if the president changes? And let's just assume that Biden's not going to live to 100, right? Eventually, whether it be, this election or the next one, as the president changes and takes this executive order that was from the previous president, is this a political volleyball, or is it once the ruling has been made and they start running down a path, is it kind of assumed that it'll just continue to that more progress will be made or what have you?
Yeah, it is something of a political football, but remember this dates back to the CFPB work on this dates back to 2016. So they've already been through 2 different colors of administration.
That's a good point.
And once it swaps over from being a executive order, hey, go look at this, to something that actually gets implemented, my perception as a citizen is it's easier for a president to undo activities going on under a previous executive order than it is for a president to take rulemaking that resulted from an executive order and upend the rulemaking. It depends on how quickly this stuff happens. But at the end of the day, presidents of either color feed their supporters. And I don't know that there's such strong support. I don't know that this is a top of mind issue that would cause a lobbying entity to go back to the president and say, you have to undo this. It's frustrating. It's slow. It's a little bit of work. But properly implemented, it actually kind of raises the bar for everybody. It creates some improvement for everybody. One of the things about open banking, when it started in the EU, UK, it was all about consumers being able to pick up their information and drop it into another organization so they could, air quotes, more easily move their bank accounts. Turns out that that's not how it's been used. But here in the US, people think, oh, open banking is about people stealing my customers from me. And if the perception of the financial institution is, people are going to steal my customers from me, I would counsel that financial institution, they got to focus a little bit more on their customers, right? Like they should be offering services that make their customers not want to leave. 1033 is not going to change whether the customer wants to leave or not, right? Make your services better. Oh, by the way, you stand to benefit as much as the person stealing your accounts. You can steal their accounts, right? So in an equalized world, now a market-driven economy, it's like, does it deliver better products, and all it will do is provide benefit to you.
Yeah, that's great. And I would say that's probably a vendor conversation as much as a bank conversation as well.
Correct.
To some degree, that the banks may not be locking down this concept of open banking. They may.
Yeah. And by the way, in the background, there's nothing. The consortia are never allowed to talk about pricing, but I doubt that all of this will need to be done for free. Right? There's nothing in Dodd-Frank that says you have to make the data available at no cost. So if a fintech comes along and wants to consume it, there's a better than zero chance that they're going to have to pay somebody.
Another technology standard, think of like the Bluetooth technology standard, right? At some point, somebody said, we have a bunch of devices we need to connect. So we need one easy way to do it. Let me make another analogy. So take a look at the Bluetooth standard versus plugging your phone into the wall. The Bluetooth standard allows all devices to connect to each other. But when you buy a plug for an Apple device versus an Android device, it's two different plugs. It used to be like 6 different plugs. You'd have to figure out, which plug it was. If everybody had the same plug, that'd solve a bunch of problems. Right? Again.
Yeah. Moving in that direction, I think in the EU, they just mandated USB-C. Yep.
Yeah. So conceptually, right? I guess the thought would be, if you think of the European system maybe as Bluetooth and the US system as the plug, it came about a different way, and the result is certainly far different. But to get that plug standardized, it's it's taken quite a few.
Yeah, and I'm going to use a different analogy, but I think it gets to the same point, Charlie, which is, let's go back to mobile phones. I'm old enough to remember that when I got my first mobile phone, I could make calls on my mobile phone under my monthly subscription to other people who had a mobile phone from the same provider. If I needed to call someone at another provider, it was an extra 12 cents a minute or whatever as a roaming charge. And oh, by the way, SMS messages at the time, which were new and hip and cool, were 25 cents to send and 12 cents to receive.
Wow.
Right?
Wow.
Fast forward to today, nobody buying a mobile phone plan thinks about all that stuff. Why? Because back then, not everyone had a mobile phone. So the mobile carriers were still fighting for real estate. They were trying to grow the market from 10% of the population to 50% to 75%. Once the percentage of the population that has a mobile phone hits 95%, they are no longer fighting for getting someone to buy a mobile phone. They're fighting for, I want you to use the mobile phone and I want you to use the mobile phone on my network. So they started competing against different things. And they realized that these kind of nuisance costs that they were layering onto the customer, they would drive more volume if it was easier for the customer. So when I call you, I don't even ask you, are you on Verizon or are you on AT&T? Because it doesn't matter, which means I'm more likely to just pick up the phone and call you. I think that we're at that moment in financial services with regard to this whole API thing that, we have a whole series of providers that are not financial institutions offering really cool capabilities via API, and everybody's fighting for their own real estate right now. For a certain subset of functionality that a financial institution might be able to offer via API, 1033 has the potential to standardize that. And that could be a, rising tide raises all boats kind of thing. Again, properly implemented. Always a little bit of spaghetti making with regulation. So if it comes out well, I think it will be a net positive.
Well, Peter, I think that's about all I wanted to cover in this podcast. Is there anything we missed? Anything else?
We had a broad-ranging conversation, which is always fun, Charlie.
Anything else we need to cover that you can think of?
I think we covered this well enough. If they come away with some questions, that's a good thing. So, I would encourage them to respond to the podcast, ask you, ask me. Always happy to engage deeper in the conversation. But I do think that 1033 is no longer an if, it's a when. We will have some form of API-driven information exchange in the United States. Now, we are going to call that open banking. It's going to be different than the open banking that we call open banking in the U.S. today.
Excellent. No, that's a great perspective. That's a really good, and I appreciate kind of the history lesson around the European side and the concept around how that formed versus how we formed, or basically how our system formed over here. That's very interesting and pretty useful. So, okay, Peter. Well, thank you for joining us on Bank Talk today. I appreciate your time.
Thank you for having me.
Thank you for listening today. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast. If you'd like to reach out to Peter Tapling, you're welcome to go out to his LinkedIn profile or look up PTAP Advisory. Thanks again, and we will see you in the next episode.